Hello, chart watchers, and welcome to this Thursday, February 28th, 2019 Market Watchers live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, a lot of the same that we've seen this week so far. Market down early, trying to rally back. Currently, we have the Dow Jones Industrial Average down 30 points. The S&P 500 down 2.5. The NASDAQ rallied back quite a bit off its earlier low, down about 5.5 points. The Russell 2000 down 2 points. 10-year Treasury yield yesterday made that break above the 20-day. Today, adding to it. This could be good news for equities down the road. Volatility index down just barely. It was up earlier today. It is at 14.67 now. Real estate back in the lead. Does have that negative divergence in play. Looked like it might be breaking down, but it is rallying back today. Energy prices are down. Obviously, energy struggling today, down more than 1%. Materials also moving down more than 1%. In the earnings news last night and this morning, you can see Monster having a very, very strong day. Top performer in the S&P 500, up $5.50. HPQ and Booking Holdings, though, both went in the opposite direction. These are the two worst performers in the S&P 500. And this kind of illustrates what happens when you hold into earnings. Which way is it going to go? Monster on the positive side, HPQ and Booking to the downside. All right, Erin, hard to believe, February 28th. And I'm just going to say right now, I am not going to trade this year on the 29th, 30th, or the 31st.
You're not. You did not.
Not going to, because it's February and there are no such days.
Oh, yeah. See, I'm trying to wake up, guys. Forgive me. Yeah, I am not planning on doing a whole lot of trading in January at this point, for sure. Actually, I'm not doing a whole lot of trading in general with the market doing what it's doing. Are you in the market a lot right now?
Oh, yeah.
Yeah.
Yeah, I've been in on the long side. I mean, I finally gave up. I tried to short 3 times. I had 3 different levels in mind where I thought we'd get reversals, and when we didn't, and the market kept going up, we're getting leadership from some of the aggressive areas. And then especially when we got through 20-week EMAs, now we're, PPO, weekly PPO crossovers above the center line. That never happened during prior bear markets. I don't know. The signs to me just suggest you got to be on the long side.
Yeah, fortunately, that's kind of where I usually am. I've just been in those defensive areas, and now I'm feeling pretty good about it because I think we've been talking about it. I look at the market as kind of toppy here right now, at least in the short term. So I don't really want to expand anything at this point.
Yeah, and I think, too, I got a friend who was, well, I'm pretty sure he still is a portfolio manager for Wachovia Securities. Actually, no, he left Wachovia Securities, but that's not important. The important thing was a quote that he used to always use, and he said, it's okay to be wrong, but it's not okay to be wrong for long.
There you go.
That's it. Got to adjust with the market, follow your signals, be very disciplined. And I know, you take a little bit longer term look. I take a much shorter term look. But I think when your signals turn, you can't argue with what the market's telling you.
Yep. I might not always be right, but I'm never wrong. That's what somebody told me.
That's a good one, too.
Yes.
All right. What do we got?
Right. Let's get this show on the road. Okay. Upcoming schedule. Well, Tom, today you're doing your workshop, so pretty excited about the seasonality report coming up. Wait, that's next week. That's Tuesday. You've got another special to get ready for.
I do.
And then we have Milan Vashnu. He is one of our new bloggers on India markets. And then Bruce Fraser, Mr. Wyckoff, is going to be here on Thursday of next week. So should be a great week. But today, what are we doing today? All right. Well, there's that seasonality report that Tom will be doing for us first. 10 and 10. The first symbol is going to be Molina Healthcare, MOH. And then I'm going to finish up with a segment I'm calling Things That Make You Go, I'm going to look at a couple of charts that have been piquing my interest that you might want to look at. So that's the teaser there. Okay, Tom, technical news headlines. Let's go.
All right, let's start with the key economic reports that were out this morning. Initial jobless claims, of course, every Thursday they come out. They matched expectations, 225,000. We did get Q4 GDP, and this is the initial reading. It would have been out last month, but because of the government shutdown, they are combining the initial and second estimate. And so that came in this morning better than expected, 2.6% versus 2.2%. And then finally at 9:45 this morning, just after the market opened, February Chicago PMI came in much stronger than expected, 64.7 versus 56.1. And we'll take a look and see what is going on in the bond market. And for the first time, we're actually getting some follow through after breaking above the 20-day moving average. I think this is very significant. We did gap down at the open, but we are starting to see more strength in the yield. And of course, that means that there is selling going on in treasuries. When they're selling in treasuries, usually, not always, but usually it's because investors, traders are starting to look ahead, see economic improvement ahead. And as a result, they reposition themselves somewhat out of the treasuries, just to start to reallocate a bit of what was in treasuries, and they move them to equities. And as a result, you see the yield move up. So this is pretty significant. I also want to show this is a long term. Now, this goes back 5 years, and it's also daily chart. So there's a lot of back and forth. I don't really want you to pay too much attention to the individual line items. What I want you to see, first of all, is that we are in an uptrend. This is the treasury yield. The pink line is the S&P 500. And the reason I put that under here, under the 10-year treasury yield, is I just wanted to kind of point out what happens when you get strong rallies in the 10-year treasury yield. So back here in 2014, you can see a big move. You can see the S&P go right along with it. Another one here in October of 2014, the S&P goes right along with it. Now, does it happen every time? No. We had a really strong move in the middle of 2015, and the S&P just simply went sideways. But take a look at what happened when we had the huge move back in late 2016. Big move here, and that was the start of the equities moving up with it. And the reason I point this out, you can see another big one late 2017 into early 2018. Huge move up in the 10-year treasury yield, and you can see the S&P going along for the ride. The reason I bring this up is that I think that there's a lot of misinformation given, sometimes talking about, well, higher interest rates cause the market to go down. Well, that's not true. From low levels, higher interest rates are really not a bad thing. You can go back to the 1960s and see one of our best decades on record in the S&P 500 occurred while the 10-year treasury yield was going from 2% up to 6%. And it wasn't until we got through about that 5.5%, 6% level that the stock market started having problems. So we still have historically low interest rates. And if we start to move back up again and break out on that 10-year treasury yield, you have to at least pay attention to the fact that when we go higher on the yield, most times that also corresponds with strength in the S&P 500. All right, let's take a look at some of the earnings reports that came out last night and this morning. One of the big ones, and this one was a little bit of a surprise to me being a seasonal person, Booking Holdings talked about this yesterday. They did beat on their bottom. They beat on their bottom line. They did, I believe, let me just double check this. I think they came up just a little short on their top line. I think they were, yes, $3.21 billion versus $3.23 billion. They also guided Q1 earnings per share lower. So we'll take a look at this chart in a minute, but the combination of missing their top line, guiding lower, they were downgraded by a few different financial firms earlier today. This is not a good combination for Booking, although I wouldn't be surprised given seasonality to see at some point a bottom go in and see this stock start to recover. There were a number of other companies, as you can see on your screen, that reported. Monster Beverage getting a really nice pop today after beating there on both top and bottom line. They authorized a new $500 million share repurchase program. Square, you can see the bottom line beat, but that was a disappointing report. They beat top and bottom line, but they guided their Q1 earnings per share lower. So stock definitely had a little bit of a problem there. And we'll go ahead. And by the way, after the bell, there's some big names coming up too. VMware, which has been acting very strong on the chart, they report tonight. Workday, one of the strongest stocks out there, software stocks, also reports. Autodesk, Splunk. It's going to be a big night for the technology area of the market. Okay, let's start off with Booking. I'm going to pull the chart up. Let's take a look at what's going on there. And you can see Booking with the huge gap down today. Opened at 1754, continues to trade down. Look at that volume coming in. I don't know if it goes back down to test this area around 1620, 1625, but that is certainly a possibility. And if it gets there, we want to watch closely to see if it holds. If we put in a move down below, an intraday tail below that low, and then we come back up and hold it, that could be a sign of a potential reversal in booking holdings. For now, however, I would just be watching to see. There's too much volume and too many sellers right now for me to try and get in the way of it. But this is one that certainly could turn. HPQ, this is HP Inc. This is the biggest loser on the S&P 500. They also came out with their earnings. They missed on the top line, $14.71 billion versus $14.81 billion. Just matched the bottom line, and they guided in line. Apparently, it just wasn't good enough. So HPQ taking a big hit today, down more than 16%. Mentioned Monster. Let's pull up the chart and take a look at Monster. Monster had been improving on its chart, and this certainly is not going to hurt. Big move up, very heavy volume. I'm going to take a look at a longer-term weekly chart here, see if we got, yeah, it definitely looks like we had equal lows. We had lower highs, so that is a descending triangle, but off of an uptrend. So we did break out of that to the upside. I think it's bullish. I suspect we're going to make another run for 70 on Monster. And then it's pulling up Square. Square, a little bit of a problem earlier, but the good news, bouncing off the 20-day moving average. So it is performing pretty well, given the fact that the report was not received very well last night. After gapping all the way down at 75.92, the stock now back to 79.58, trying to make a breakout. That would be bullish, given the not so great guidance in Q1. Let's see. I'll do one more here. Let's take a look at Budweiser. Anheuser-Busch trying to gap up to break out above this area. I see off of a downtrend, maybe a bottoming head and shoulder pattern. Left shoulder, neckline. Here's the head. We come back up to the right side neckline, which is slightly upsloping, which I like. Right shoulder. And now with the earnings, if we can get a strong finish today, maybe we get that breakout on Anheuser-Busch. All right, let's go ahead and go over the upgrades and downgrades, and I'll get ready to deliver the March seasonality in just a few minutes.
Excellent. Let's do this. All right. It's another day where I went in and there were just a few upgrades and a long, long list of downgrades. So I'm going to start with the upgrades. And Fitbit was upgraded, but boy, you really wouldn't know it when you look at this chart. And I would have to say I wouldn't have been upgrading it to begin with. I think we already had a notion that something bad was going to happen. You could see here we got the PMO sell signal, and twice, well, this time is because of this drop, but we saw it come up and not be able to get above that signal line and head back down. And look what the PMO tops were doing with the price tops. I think we had a pretty good warning that we might not maybe see a gap, but certainly see maybe a breakdown or a test at that 625 area. So instead, though, we got the big gap down. I don't like it. If it dipped down here below the 200-day EMA, they have their target now at $7. So, hey, I'm not into that. Maybe we'll get that. This turns out to be a big island and we'll get the move back up there. But the chart just doesn't look healthy yet to me. All right, the next one, Hain Celestial Group. Let's see here, make that bigger. All right, so Hain was upgraded today by JP Morgan from a neutral to an overweight. And their target was is $20. Looks like we're going to make that without much trouble at this point. There are a lot of good things, but a few bad things going on. Let's start with the good news. The good news is, of course, we have this really beautiful short-term breakout. Really like that. You can see the 5 and 20-day EMA have just crossed paths to give us a short-term trend model buy signal. You can see the PMO is just about ready to get above the zero line. But what are the problems? I'm looking at this OBV, and generally what you want to see, of course, are when you get the breakouts and such, and we'll find out after the close today whether this will be true. But you want to see the volume top, the OBV top, get above the previous one if you're going to have a breakout. You want to have some confirming volume there as far as the OBV goes. And right now we really don't have that. But after the close today, when it is calculated, we'll have to look and see if it gets up above that previous top. If so, I think we're looking at a pretty good move here for Hain Celestial Group. All right, let's look at some downgrades here. Pulte. And what I wanted to mention too about home builders right now is that Evercore downgraded a handful of them. The only one I saw that was missing was Beazer, but Pulte, Toll Brothers, let's see, who else was downgraded? We have quite a few that came in as far as Evercore was concerned. They aren't liking the home builders apparently. And I have to say, it's not been the greatest area, certainly for performance. I decided I'd take a look at the Pulte chart. It's somewhat representative of the other ones. And I could see some of the issues that might be troubling analysts right now. Here's the first one. This is a really strong area that was previous resistance and support. And that is now being broken down below. Don't like that. If you want to look in the shorter term, let's see, here's the next level of support, I'd say is right about, well, you've got to close right there, and that kind of matches up in there. You're sitting right on that support level, but look at the PMO. It's really ugly. It did give us that, this one would be a bear kiss. It came up, but it actually gave us the buy and then whipsawed into the sell. You can just see that it's been in really a trading range, hasn't been doing that much from December when we had, I mean, think about it, from that low, most of the charts we're seeing had V bottoms, you know, and they made a great move to the upside. I mean, I guess for safety's sake, being there in a sideways moving stock might not be a horrible thing, but certainly not a place I would be looking at this point with that confirmation of the PMO tops moving lower. All right, next downgrade for you, Regions Financial. Sandler O'Neill downgraded it from a buy to a hold. And let's take a peek at this chart. It is looking overbought, but at the same time, I see negative readings on the PMO all the way down to -5 and -7.5. So my first thing to do is I really want to know, is this truly overbought or not? So I'll just take this out, the daily chart out to 7 years, and that will give us a better clue as to what's going on with the PMO range. And I usually get my little rectangle tool. I'm going to make this so we can see through it. And that usually will give you a pretty good idea. And it looks to me like -5 to 5 is a pretty, you know, looks pretty, well, it looks like the normal range really for the PMO for Regions Financial. So we are on the overbought side, but we're not like critically overbought. It's not, you could still see it move higher. Let's go back here, and I want to look at the daily chart once more for you. What I see too is a lot of these V bottoms we're getting, you almost could look at them as reverse head and shoulders, not really textbook, but I still think that they're positive formations right now. So when I look at this one, Regions Financial, I don't see it as a horrible downgrade at this point, but you do have a somewhat overbought PMO. And if you look in the shorter term, we do have some overhead resistance to get through. And that lines up as well with those, with the lows here and here. I should have put that on there for you. Rio Tinto was downgraded today by B of A Merrill from a neutral to an underperform. Not liking it, like a lot of stocks, overbought PMOs. And now right here, I suspect we're going to get the sell signal either today or tomorrow. And looking at the shorter term here, that $57 range could hold up as support. But when I see a PMO this overbought with what looks like a pretty clear sell signal lining up, it's just not interesting to me at all. I don't touch it. So I think the downgrade's probably a good idea. All right. Lending Tree, the last one I'm going to go over. UBS, buy to a neutral. They have their, let's see, their target at 320. So we're right about there. You know, I'm obviously, they've set it up to a neutral. So I think that's why their target is around 320. They're just not expecting it to do much. I wouldn't either. I have the PMO sell signal. And remember on that previous chart where we had that top below the signal line, there were a lot of things that looked a little worrisome, even though the PMO was flat on the chart here. So I think this is giving us some warning, guys. You know, we have the luxury now of looking at this chart, and rather than looking at it after a gap down, we get to see it with that sell signal on there. So I'm not liking lending tree that much. The next area of support is what it's kind of sitting on, is that 300 level. So if it doesn't hold that, it certainly is going to be a long way down, in my opinion. That's all I got for the upgrades and downgrades. Here you go. A couple of extras that you might want to know about. Upgraded was Crocs and Dicom. Wabco was upgraded by 2 agencies. Downgrades, as we said, Booking, Box, Cerner, more of those home builders, D.H. Horton, KB Homes, Toll Brothers, just to name a few. And that's all we got. I will post this in the Market Watchers Live recap if you want to look at all of those symbols on your own. All right, Tom, seasonality. I know it's been unseasonably cold here in Southern California. What's the market looking like for next month? What's the forecast?
Well, the seasonal forecast is sunny skies ahead. I mean, when
Excellent.
when you take a look at the S&P 500, and I'll give you some data, but you can kind of look at this chart while I'm giving you some numbers in the background. But here you can see March and April. On average, the S&P 500 has gone up on average the last 20 years 1.6% in each of these 2 months. Now, the odds of it going up are certainly better in April, which rival November for the best month of the year. March is only at 58%, but still has produced the same in terms of returns. And when you look across all of these different months, all calendar months, March and April are the 2 best over the last 20 years. Now, I've got some information that goes back to 1950, which is almost 7 decades. But I can tell you that on the S&P 500, March has been higher 44 times out of 69 years. So that's a pretty good ratio. And it's gone up, it's produced annualized returns of 13.9% over the last 69 years, which is well above the 9% that the S&P enjoys throughout the year. So you've got a little bit better performance than average. March ranks as the 4th best month out of the 12 calendar months on the S&P 500 since 1950. So, overall, I'd say we got some pretty good numbers there. The NASDAQ and the Russell 2000, not going to talk too much about those two because they tend to follow suit. The NASDAQ has averaged about 10% during the month of March, and that ranks 6th out of the 12 calendar months. Russell 2000 is actually a little stronger. March has produced annualized returns of 20.06% on the Russell 2000 since 1987, and it's gone up 23 out of 31 years. So I could pull this up, and we'll just pull up the Russell 2000, let you take a look at that while I give you a few more numbers. But here you can see, look at March standing up there, rivaling November and December. March is the 2nd best month of the year for small cap stocks. And you can see that pretty much stands out here over the last 2 decades. Now, notable periods within the month. The S&P 500 from March 1st to March 5th has an annualized return of 36.17%, which is 4 times that 9% that it enjoys throughout the year. So the 1st to the 5th tends to be a very strong part of the month or in March. And that's typical with most months. Another strong period is March 10th to the 19th. And of course, 11th to the 18th historically of all calendar months is pretty strong. So March follows in that same way. From March 10th to the 19th, annualized return, 36.89%. So again, that's that period that just before and just after the middle of the month tends to be very strong in March. And then the worst period in March is very similar to most other calendar months, March 19th through the 24th. Actually, let me go back. That strong period was March 10th to the 18th, not to the 19th. The weak period starts March 19th, goes through the 24th, and there is an annualized return of a negative 10.19%, March 19th through the 24th on the S&P 500. Now, the other major indices, the NASDAQ and the Russell 2000, tend to follow suit for the most part with the S&P. The one big difference I noted was that the Russell 2000, March 29th to the 31st, has an annualized return of 48.56%. And somewhat surprisingly, the S&P 500 and the NASDAQ don't really show a lot of end-of-month strength. April, the early part of April does tend to be strong, especially on the S&P and the NASDAQ. But for some reason, we don't seem to get, or at least historically, we haven't seemed to get that same pop into the end of a calendar month, into the end of March, like we do other ends of calendar months. Now, while we're looking at this, the Russell 2000, the fact that it has been so strong, as we head into March, it's a strong month. I just want to point out, if you're not aware, that the Russell 2000 has been very strong relative to the S&P 500 so far in 2019. We've seen a little bit of a pullback recently, but for the most part, this has been a pretty nice looking chart here. This is a relative strength. So this isn't just telling you that the Russell 2000 is going up. It's telling you that it's going up faster than the S&P 500. So we're entering March, which is typically a much stronger month for small caps, already on a roll on a relative basis for the small caps. So I thought all that was worth mentioning as we head into March. Okay, let's talk about the sectors a little bit. Now, the leading sectors in March and April have, at least over the last 2 decades, have tended to be financials and energy. So I'm going to pull up the seasonality first on the XLF. And when we go back the last 20 years, you can see the average return March and April on financials, 2.5% and 2.6%. Add them together, 5.1%. The XLF has averaged going up the last 20 years. And when you look across here at any other combination of 2 months, the best I see is 1.8%, October and November, or November and December. That's nowhere near the 5.1%. So financials historically have done very well in March and April. And what's really interesting here is that we're starting to see that 10-year Treasury yield break above the 20-day moving average. So if we go back over, I'll pull this chart up here, 1 second. If we take a look at the 10-year Treasury yield, the 10-year Treasury yield is now breaking up above that 20-day moving average. Why is that significant? Well, if you look back at the 10-year Treasury yield, when it goes higher, the tendency is for financials to outperform the S&P 500. So we're starting to get a little bit of a breakout here on the 10-year Treasury yield. At the same time, we know that we've got relative strength on financials historically beginning in March and April. Now, this is the absolute strength. So how do I know that we've got relative strength? Well, we've got relative strength by comparing this to the S&P 500. And then we update, drag this back. And you can see that in March, 58% of the time, the XLF outperforms the S&P 500, 58% of the Marches over the last 2 decades, and average outperforming it by 1%. Same goes for April, 1%. So this is the sweet spot for financials. If there's one historical sweet spot over the past 2 decades, we are just about to start it, March and April. With the 10-year Treasury yield breaking out, I think that that could add to some seasonal strength here in financials. So I think it would be worthwhile taking a look at some financials, and I'm going to pull some of those up for you in just a minute. Before we get into individual stocks, though, I wanted to show you the energy, the XLE. Now, I have problems with the XLE, and I'll share that with you in just a second. But first, we can take a look and see that the XLE also does very well March and April, 5.3%. And when we look back, there's no other 2 months anywhere close. Now, this one I have a little problem because the 10-year Treasury yield is confirming the seasonality. But the problem with the XLE is that the dollar has been climbing for the last 8 years. So I'm going to show you, let's first go over here and take a look at the dollar index. And I'm going to drag this out. Let's make it a weekly chart. And let's go back. Let's go back 20 years on this weekly chart. So you can see first off that really you can see the dollar bottomed back in 2008 and has been working higher off of that low. Prior to that, we were downtrending. Now, what's really interesting when you pull up the XLE, yes, this is the average, and March and April has been strong. But what happens if we compare this to the S&P 500, number one, and then let's only go back for the last, well, 10 years, 11 years. I mean, if we go back to 2008, and the reason I'm doing that, this is where the dollar bottomed. So the dollar's been going higher for the last 10, 11 years. So over the last 11 years, you can see March actually, the XLE is underperformed. April has still been pretty strong, but March has actually underperformed. And when you look across all of these returns, you can see that for the most part, outside of April, energy has been a laggard. And that is typical when the dollar's on the rise. Now I'm going to shorten this to 8 years. And I'm going to drag this over to 2001 to 2008. You can see that right up here at the top. So now we're looking at what's been going on in the 8 years. Let's go back and look at that dollar chart. In the 8 years from 2001 to 2008, when the dollar was going down, and look at the impact. Now, when you look at the bottom, look at how energy pretty much has outperformed almost every month. And March and April have been very strong relative performers. So I think you got to take a look at this. As long as the dollar remains in an uptrend, I'm not sure that we're going to see that historical outperformance in the XLE, because the last 20 years, really it's more about the 2001 to 2008 period than it is about 2001 to 2019. So as long as the dollar remains strong, I'm going to have issues looking for outperformance from the XLE. So this is one situation where I think it's a good idea to think about other. You can't just look at the seasonality and start making investing decisions based entirely on seasonality. I think we have to consider a lot of the other factors and what's driving the market. And so again, I think if we break that down, I think it's pretty clear that energy really struggles versus, when we have a rising dollar. Now, materials, which I didn't really bring up, but I think if we take a similar look, and let's look over the last 11 years, well, we've had a little bit of outperformance. But if we go back and we drag it, and I did not look at this earlier, so maybe it's not even going to prove my point. And of course it doesn't. March and April were pretty flat relative. I was hoping we'd see some. I think overall, we're clearly seeing more relative strength on materials, but March and April didn't pan out. If we take it to the 11 years and drag this back over, you're going to see more negatives. You're not going to see nearly as many positives coming across here, because again, materials are not going to perform as well on a relative basis when we have the dollar rising. It's going to do much better on a relative basis when the dollar's falling. Okay, so what's lagging? We talked about what's leading, XLF, XLE. That's historically anyway, and I like the XLF a lot better. But what's historically lagged? Well, as you can imagine, if the market tends to do really well in March and April, aggressive groups are likely to lead and defensive groups are likely to lag. And if we pull up the XLP and compare that to the S&P 500, you can see that March and April are both laggards for the XLP. So if the market follows suit and continues moving higher and follows the seasonal pattern, my guess is, based on seasonality, we're going to see underperformance in those defensive consumer staples names. The other defensive group is the XLV. So we also have healthcare relative to the S&P 500, that when we look over the last 20 years, you can see March, first of all, it only goes up. The healthcare group only goes up faster than the S&P 500, 37% of the marches over the last 20 years. So that's roughly 1/3, a little bit more than 1/3. And you can see on a return basis, the XLV underperforms by about 0.5% on average in March. So a couple things to think about as we head into what typically is a very bullish period in March and April. All right, so let's take a look at some of the groups that I would consider in the financial area. And I'm going to focus on financials, not energy, because of the reasons I talked about with the dollar. So let's take a look first at the DJUSES, which is real estate services. And when we pull this back, look at it. Now, there's only 12 years worth of history, but look at March and April and February even. This since the beginning of the year. I mean, really January, February, March, April, this is a strong period for real estate services. If we go back over here to the chart on real estate services, look what's happened since the beginning of the year. Following seasonality to a T so far. It's been a very strong group, January and February. And historically, we should expect that to continue. March is the best month of the year for real estate services. Now, again, this is only 12 years. I prefer being able to stretch it out 20, but we don't have that data. So we only have 12 years worth of data. So the sample size is a little smaller, maybe put a little bit less stock, no pun intended, in this data because of the shortened sample size. All right, so that's one group. How about hotels? About a month or month and a half ago, I was talking about the strength in hotels and how it was picking up. Really liked what was going on with the hotel group. Look at March and April, seasonally. I mean, if that doesn't just stick out like a sore thumb there, actually not a sore thumb at all, good thumb. March, April, averaging over 13% a year gains in hotels over the last 12 years. And then we pull up the chart to look at what's going on. And I think you're going to see a lot of improvement here on the chart as well. January, February strengthening. This has been a very, very good part of the market. And I would suspect, based on seasonality, we're going to see that continue. All right, next up, let's talk about the retail REITs. And over, you can see March over the last 12 years, up on average 1.6%, April 6%. So 7.6% between them. And you can see much better than a 50% chance that we're going to see strength in this area during March and April. Next one up is the DJUSEH, which is the Real Estate Holding and Development Index. And once again, only 12 years, but February, March, April. And we could go over here to the DJUSEH, take a look at the technicals. And I would say that not as strong as, maybe the rebound we've seen in other areas, but so far holding that rising 20-day, and we're actually testing it today, bouncing off of an earlier low where we were below that level. If we can get back up above the 20, this could be an area that begins to show some strength here in the short term. And then the last one, I'll go ahead and bring up the chart here first, which is full line insurance. This one I think is really interesting to me technically. And I'll just draw this horizontal resistance line coming across here. I think it's pretty obvious that 42 is a big level on the full line insurers. And we have recently gone above it a few times intraday, but we can't get through it and hold. If we can do that, I think that's important, because when we go back and we look at the seasonal chart, you will see, if we drag this back the last 20 years, March averages 4.8%, April 4.2%. That is 9% between these 2 months. So if we can get that breakout technically, and then we know we've got really strong action historically, seasonally, in March and April, I think that would add to that technical picture, which would be very bullish at that point. Okay, now, how do we find individual stocks that also offer up some nice seasonality? Well, I'm going to focus on that first financial industry group, real estate services. So that, just as a reminder, let's go back over here and put that chart in here. So you can see the strength. I mean, I don't think there's any doubt that we are in a beautiful uptrend. Haven't even had a 20-day test yet. I would certainly expect one at some point. And if we get one, knowing what we know about seasonality, it might be a great time to be looking in this group. So how do we look in this group for seasonality? Well, I'm going to go back to the dashboard on this other screen. And I'm going to pull up scooters. So remember, we can search through the large cap stocks. All we have to do is type in some information. Well, how about real estate services? And there you go, one large cap stock. And if you notice, this was on your poll as one of the stocks to consider looking out over the next couple of months, because this is a strong seasonal performer. Now, once they come up, once you get stocks that meet your criteria in your search box, you could have the option over here to click on seasonality. So let me just click on the seasonality for CBRE. Let's pull this back. Over the last 16 years, CBRE has gone up on average 9.1% in March, 7% in April. So this is a stock that seasonally really performs well over the next 2 months, 16% on average over 16 years. When you look back at all these other calendar months, I mean, you don't see anything like this. I mean, November and December strong, 5.7%, but 16.1%. March has gone up almost 80% of the time for CBRE. So seems to me like, all right, let's take a look at that chart. What's going on there? Well, I would say got pretty good action. And look at the volume coming in February to support this move to the upside. Looking longer, looking out 3 years on a weekly chart, you can see we're just making a breakout above the midsummer high in 2018. This downtrend ended. We're now above the 20-week moving average. I think CBRE looks great technically. It's a little overbought, but all that means to me is a pullback is an opportunity. So that is something that, based on seasonality, going through and seeing that financials outperform, that real estate services outperforms, and that this stock outperforms, a pullback technically on the chart, I think would set up a great opportunity. All right, so let's go back over here and actually let's go back to this chart. So let me type in the real estate services again. And let's pull up mid-cap stocks. All right, now we got a couple of others. Here's Jones Lang LaSalle with a scooter of 88. So this is going to be a pretty nice looking chart, I'm sure. What does the seasonality look like here? Over the last 20 years, the stock has averaged gaining 6.6% during the month of March. So it's another one where, okay, let's take a look at the chart. We'll pull up the long-term chart first, or longer term. This one hasn't quite made the breakout, but you can see it certainly has strengthened, and it's back up above its 20-week. Let's pull up the daily chart. And I'm guessing that was earnings related. I'd have to go back and look. But if that was a positive response to its earnings, I think the rising 20-day, certainly the top of gap support, would be a very strong entry, especially given the historical and seasonal nature of the stock and how it's performed. All right, another stock. Let's go back to this listing. And Zillow. This one's really interesting because Zillow hasn't been around very long. But look at the seasonality. First of all, when I looked at the 5-year, and it only goes back 5 years, but look at the left side of the chart and look at the right side of the chart. Now, of course, Zillow being in real estate, is it a coincidence that the first 6 months the stock does really well and the last 6 months it doesn't? Or is it based on something that's going to continue? May and June, look at May and June, been up every year. And average is going up 30%. Now, again, we're only talking about 5 years, not a lot of history here. But the first 6 months of the year just absolutely crushes the second half. I mean, 5 of the 6 months in the second half are negative. September's up on average 1.1%. First half, every month's positive. Many of them, significantly so. So Zillow, to me, looks very interesting as a seasonal candidate. And when we go back and pull up the chart, notice we just had a really big move with heavy volume. I think things are starting to turn to the upside on Zillow. And I know it's only 5 years of data, but that was pretty compelling what I saw on the seasonality chart. So I think Zillow is one to maybe keep an eye on as well. All right. Let me just go through some other individual stocks that I noticed are very strong performers seasonally. I've talked about this one quite a bit. booking holdings. They did just come out with horrible numbers last night. Actually, the numbers weren't that bad on the last quarter's report, but lowering their guidance going forward is never a good thing. But this is a company that really excels in the first 5-6 months of the year. So yes, today's having a horrible day, but that was the reason why I was talking about maybe if we can find a bottom, this is a stock that maybe could rally given its seasonal history. Another is Alta. Before I go into Alta, I'm going to pull up the retail, just XRT. Very diversified ETF. And you can see that retail tends to do very well February, March, and April. So keep that in mind as well. Let's move on to Alta. Look at that. I mean, now that sticks out to me. 91% of the months over the last 13 years. So basically 12 out of 13 years, Alta has risen in March, and its average return is almost 9%. So when I look at the chart, I'm looking to see, okay, well, it's right up against resistance. If it makes that breakout, it certainly could have another good March. I mean, we know how fast Alta can move. We've seen that a couple times here just on this 6-month chart. So look to see, if we get the breakout on Alta. One stock, I'm going to pull up the chart here, Align Technology. Not really anything overly exciting to me on the chart here. But from a seasonal perspective, this is the time of the year where Align can have some really nice returns. March, 4.1%, April, 10.7%, May, 5%, and the percentage, the odds that it's going to go up goes up over the next 3 months. So I don't know if we start out strong in March, but if we start to improve tactically, just keep in mind that April and May have been the best 2 months of the year on Align, and that's over the last 19 years. All right, I'm going to pull up one more, and then we'll pull up the poll. Let's talk about Foot Locker. Foot Locker, and by the way, it looks pretty good technically as well to me. But Foot Locker, you can see February's okay, 2.7%, goes up 70% of the time. March, average is going up 8.8% and goes up 68% of the time, so roughly 2 out of every 3 years. And we look at the chart, and you can see we just recently broke out on Foot Locker, bouncing off the 20-day moving average. I don't know, it looks pretty good to me. It looks like Foot Locker, as we head into a very strong seasonal month, March, I think Foot Locker looks pretty good. So let's pull up the poll. And Erin, I don't know if you had a chance to, put your pick in, but, I'm sorry. Let's do the summary. My bad. That's what I just went over. Monthly index leading. Didn't really talk too much about lagging sectors and industries. I'd be careful maybe of some of the defensive stocks, especially if the S&P 500 breaks out. I think we're going to see that being led by aggressive groups. And then some stocks maybe to keep an eye on. And now we'll bring up that poll. And Erin, did you have a chance to vote?
I did. Let's see. The one I didn't like, the one I really didn't like was CBRE. And there were a couple things that really bothered me. Foot Locker actually was my first choice.
Okay.
Yeah, I liked everything about that one. I liked, I think there was like a reverse head and shoulders on the weekly chart. Some good stuff.
Yeah, I actually am a fan of CBRE, so we're on opposite ends on that.
Well, we always are. That's what's so fun.
I just think being in that financial space and with the 10-year Treasury yield breaking out and that history and this chart, has been going straight up. I'm a momentum trader. I like to catch that momentum when it's going. And very strong volume on that move in February, mid-February. Volume has been picking up. I think this stock goes higher.
Well, we'll see who's right later. Well, we never take notes, so we never really know who wins things, but
that's part of the game, I guess.
Exactly. There's somebody out there who's been taking diligent notes, and I'm sure they're going to let us know.
That would be good. I have no idea. I've never gone back. So I
know. I think there's a good reason and a bad reason. I like the idea, but at the same time, I sometimes just don't want to know.
Yeah, no doubt.
Okay, well, 10 and 10, we are ready to go. Let me go ahead and get you the list here in an RRG. Get my share going. And here we are, of course, random looking right now. I always like to shorten those tails a bit so you can see. We want to see northeast direction. So that's one thing to look for. And the CDNA actually looks really interesting because it's been in weakening. It's now starting to turn northeast back toward leading, which is some of the ones that Julius usually likes to find. So that is the RRG. And looking at, I guess people want to see some technology stocks, Tom. We got a few here.
Got a few in there.
Okay, let's go ahead and start with a healthcare one, though. Molina.
All right, Molina. You know, I'm not liking the action today. So if you take a look at the chart, actually the last 2 days, but especially today, it's unless it reverses. Maybe we get this reversal on the 20-day moving average, but you can see on the last high, the volume was not nearly as much as we saw back in January. And on this breakout, you can see that the PPO never quite made it to a new high. So it's telling me 50-day test. Now, when I look back, huge volume, second week of February, the selling was contained between 125 and 129, and that 50-day is at 129.76. So I think this is the area really to watch for on Molina on this selling. If we hold 125, I could be okay with it, but I really don't like losing that 20-day moving average. So I don't know, kind of a mixed signal here for me.
All right. And the most popular in the chat room is a technology stock. Imagine that. Zebra Technologies, ZBRA.
Love it. I haven't even looked at it. I know it's on my strong earnings chart list. Love this big volume breakout. I think this pullback is helping. We were very overbought. Now getting back into a little bit more manageable. Probably could still use a little bit more selling. Let me annotate here. One of the things I really like about the stock is, first of all, we were sideways consolidating for a long time before we got this big breakout. So I think this is I don't know what was doing before. I'm not sure if this breakaway or continuation gap, but either way, I love when you get a big earnings report that tops estimates, the market reacts positively. We get a breakout from consolidation. I think we're going to go a lot higher. Now, to the downside, it's possible we get a 20-day test, which is 191, and we've got price support all the way down at 185. So I like it better the more it pulls back closer to those levels. You can manage your risk better. But it's one of those that may not come back to the 20. So you got to kind of decide for yourself how much, whether or not you want to wait, see if it comes back. I actually maybe like dipping your toes in and adding on weakness. But I like ZBRA. I think this one goes higher.
All righty. Let's see. Let's take a look at that one that was going in the northeast direction, CDNA. Or is it?
This is another one. Or no, this is not the one that I was thinking of. I was thinking of Cadence, which was CDNS. But CDNA, I like this breakout. Again, there's your sideways consolidation. Whoops. There's your sideways consolidation for the last several months. We break out. Look at the volume pickup. So I think that's a good sign. Now, this is another one where I think the rising 20-day moving average, you got to watch. I think that's the key support. So the closer we get to that on a pullback, at some point, the better I'm going to like the stock. But I do think this looks really good technically.
All right. Let's see. Next one up is Symantec.
All right. SYMC.
Yes. Sorry about that.
That's all right. I know most of them.
You do.
Let's see. This is one I'm waiting for the breakout. So I think 23.5, 24 is big. I love this test of the 20-day. If I had seen it, I might have gotten in. Light volume coming back because I can manage my risk. I think right now your support is right at about that 20-day down to this tail. This was the earnings report that came out. So it traded down initially to about 21.75, and then buyers came in. So I think the 20-day, 22.33 down to 21.75 is your key support area here. But I like it. I think eventually we're going to get that breakout above 24.
All righty. Let's see, for our friends in Canada, Metro Incorporated. This is a food store, and it's MRU.TO.
All right, MRU.TO, Metro. I like the volume coming in, and it did clear on a closing basis prior highs. I want you to take a look at something, and this is why I don't like to buy stocks with negative divergences. Look at this. This is a perfect example of higher price, lower PPO. What do I look for? 50-day test. And there it is. So, but the good news is I think now the PPO is starting to go up. I do not consider this still a negative divergence. By definition, yes, it's a negative divergence. We've now got higher prices and the PPO is still lower, but I think we've gotten a reset. I think now the PPO is starting to rise again. So I like this stock, and on a test of the rising 20-day moving average, I would be a buyer. I think this one looks good.
All right, let's see. The next one I'm going to give you is WPC, and that's, let's see, real estate, diversified REITs.
All right. Well, I do like the area. Nice reversal here, by the way, on the 20-day moving average. Yeah, I mean, it's hard not to like the stock. I think that we did have a huge run up, so we were very overbought. Came back, RSI got close. It looks like maybe we touched 50, and now we're starting to turn back to the upside. Maybe one word of caution is that if the stock does get back up to that 76 level, watch the volume and watch the potential for negative divergence. So there is your high. PPO is at its high. You pull back, you hit the 20, you're bouncing. If we move back up and struggle to get through that level and you notice the volume doesn't pick up, that would probably be short-term sell signal for me. But otherwise, I like the long-term trend. I think it goes higher. I just think if you have a momentum issue, you may have to see that resolve before we get much movement to the upside.
All right. Let's see. How about Prudential, PRU?
All right. Well, it's in the financial space, and we just talked about how financials like the months of March and April. So this is certainly something to at least keep in mind. I think it looks good technically. I love these pullbacks that hold the 20-day moving average. So I think that's certainly something to like here. I'm looking at the resistance levels. I think the 98.75 area is probably where we're going to see this run to. And then we'll see if we can get through. We obviously have a couple of key resistance areas. If we get through 98 and change, then I think we're going to go up to 104. And given the history and seasonality of the market, I think this is going to continue. I think we go up and challenge that 104 area.
All right. From the very strong utilities sector, PPL, it's conventional electricity industry.
Yeah, I mean, I like the breakout. This is one of those defensive stocks I think is performing really well on a relative basis. I'm a little concerned. I'd like to see more volume coming in on this move to the upside, so I would definitely keep my stop in at the 20-day moving average. But we did make the breakout, clearing the November high. I think we can see that pretty well. And then this rising 20-day, which has been holding pretty much throughout. We went just a little bit below here in February. So I think that price support level now becomes very important. So I'm going to draw that in. But yeah, I think that the stock looks good. I would rather see a little bit more volume coming in. I think it's a good looking stock, but I think it's going to be an underperformer because it is in the in a defensive area in the utility space. So I'm just a little cautious on it. Pull back to the 20-day moving average, though, would provide you best reward to risk entry.
All right, let's see a semiconductor for you. ST Microelectronics, STM.
Yeah, I like this downtrend breakout. That to me looks like a breakaway gap. Nice volume to confirm, and it's been holding the rising 20 days since. So let me just draw this I mean, I'm kind of looking at this right here. And so definitely broke here, but I think even further confirmed by that heavy volume. So that to me is probably the most impressive thing on here, is not just the gap and the move higher, but the fact that it came on such nice volume. So yeah, and then you can see the next gap up over here, same thing, another big volume day. So I like these 20-day tests. I think you can keep a fairly tight stop on a trade here on STM. You can see right there. Whoops. You can see right here the test of the 20-day and the top of gap support. So you draw that across. That's your support area that I like on these big volume gap ups. So it held there, went up, and now you can see we're actually getting another 20-day test. I like it. I think stock goes higher.
All right. Let's see. Our very last one is Zynga. Bazinga.
All right. Wow. Yeah. Huge move to the upside so far, in really since the November low. A lot of volume coming in here, too. I'm going to pull up a weekly chart just to see what the weekly shows. Yeah. Nice breakout here as well. Can't really complain. I mean, we're overbought. I'll annotate the weekly chart here. But the breakout was at about 460. So if the stock gets under pressure near term and pulls back and gets close to that level, I think that the rising 20-week, which is getting close to 440, is going to continue to come up. I think if you could get this somewhere down the road at this price support area and also about the same time hitting this 20-week EMA, I think that would be a great reward to risk entry. Now, you might sit back and say, well, it's not going to go down 60 cents. Well, I've seen a lot of crazy things. It's very overbought. It absolutely could go down 60 cents. And so I would be thinking about accumulating on a weakness.
All righty. Believe it or not, that is the end of the 10 and 10. I am going to have all of these symbols up as annotated in the Market Watchers Live chart list. Just go to the Market Watchers Live blog and click on that, and you'll see the link to those live charts right there at the top. All right, time to go take a peek at what the market has been up to while we have been having such fun. Okay, time for the final market update. And what are we looking at right now? Well, as you can see, markets started what really had a really bad morning and now seem to be bouncing back. We've made up over half the losses here on the Dow, and we're coming up very close to positive territory for the S&P 500 and the NASDAQ. And the NASDAQ mid caps, S&P 400 have made their way to positive territory, as has the Russell 2000. Canadian markets, again, very much mimicking ours with the big drop in the morning and also very close to getting back to positive territory. Treasury yields, big gap up, seem to have found the intraday high and are moving slightly lower, currently 2.681. And we've got the volatility index. We got a little bit of a spike over 16, but now it looks like we're just below 15. All right, next up, UUP. We can see the dollar is rising right now, just slightly. We're up 2 cents for UUP. And GLD, we could see is having not the best day that it has ever had. In USO, big gap up and moving sideways. And we have TLT gap down and now moving sideways. All right, the sector summary for a peek of where we're doing, who's doing what. Let's get a good update here. Real estate and consumer staples are really in the lead. Utilities, all three would be considered the defensive sectors. You can see real estate is actually up over 1% currently. The laggards, materials and energy. Energy is down almost 1%. Materials, 1.25%. That's all I have for the final market update.
All right, I've got just a couple of things here, and I'm going to go into my blog article and take a look at the medical equipment index, which you can see here is getting very close to an overhead resistance level. The rising 20-day moving average has been holding for a while. So I'm going to update this, and let's take a look at the live version. And you can see we are trying to make a breakout here. Now, I think this is somewhat important. And I'm going to kind of tie this into the seasonality in just a second. But you can see medical equipment, even though I mentioned that healthcare over the next couple of months doesn't do well on a relative basis from a seasonal perspective, this is the strongest area. Medical equipment's the strongest area within healthcare, and it has been rolling versus the XLV, and it has actually been outperforming the S&P 500 trying to make this breakout. And the reason I bring this up, there was one stock I didn't mention during the seasonality, and that is ISRG, Intuitive Surgical. Take a look at its March and April strength. It averages going up 11.3% over the last 20 years just during these 2 months. So if the medical equipment area breaks out, I think that we have to at least recognize the fact that ISRG is a great performer. And if we go in and take a look at that ISRG chart, you can see all of this overhead resistance that's been coming in at about 550. We did get up to 560 recently, pulled back, and we're starting to show strength again. I think ISRG is one that could certainly benefit from a breakout in medical equipment stock. So one to keep an eye on for sure.
All right, excellent. Okay, I'm ready to show you some charts that made me go, What I actually am going to show you are charts that they were bonus charts in the Decision Point show that Carl and I do on Fridays, but there were some really interesting ones that we've been talking about, and so I wanted to share them with you as well. So I'm going to first start off with the S&P 500. We're going to take a look of the relative chart, and I'm looking at what's going on with the NASDAQ versus the S&P, S&P 100, mid caps, small caps, and see what they're doing in comparison to the price and performance. We did go over some relative information yesterday in the workshop. So one of the things I found quite interesting is that, first of all, we've got outperformance right now from both the mid caps and the small caps. And this is really where we're seeing that great performance off of the low we had in December as far as the S&P is concerned. Now, what I find interesting is that your S&P 100, of course, these are the, heavy large caps, and we have the NASDAQ. NASDAQ's been rather flat during this whole time. We haven't seen it actually, the relative strength moving lower. It's been mostly flat, yet you can see large caps big time move to the downside. And then what I wanted to note, as you can see, and I'm going to move it up to price there. I didn't want to flatten this chart out. It didn't make it as clear. So you can see when the small caps, mid caps weren't performing, that was during our big decline. They weren't performing as well as the S&P. And again, you saw very flat, in this case, movement from the large caps. So, and the NASDAQ as well was mostly flat. So really what I look for, and what we all should be looking for, is a continuation of the smaller and mid caps doing well, because as soon as they start to turn in relationship to the S&P 500, I think that is when we should start getting a little bit concerned. So we are seeing in the thumbnail, you can see they are turning lower right now, the relative strength, but we're still on that rising trend. So I still feel fairly good about it. But, in the short term, though, things are looking rather toppy. Let's go ahead. I'm going to show you the PE range chart, and this is the one that Carl usually will bring onto the show when he has come to Market Watchers Live. And what it does is it shows you the normal range based on overvalue, fair value, and undervalue. And we get all of this information from the S&P 500 website. They have a spreadsheet you can download, and they give you this information there. And what is interesting is that, here's that portion of time where we were way out above that overvalue range. We did finally start to come back into it, of course, back earlier in 2005, and then of course we had the huge loss there, and that brought price back down for sure between the two. And then we were mostly fair valued, doing fairly well, but now we're back in above this overvalue. We came down though back in there with that decline. that we saw. So in a way, that was bringing things back to normal, so to speak. And you can see if we project where we're going here on the earnings here, we should expect the price will be back within the normal range here between fair and overvalued. So I thought that was an interesting one to look at because, with this decline, it did clean out a lot of the overvalue here that we're seeing. All right, this one actually, I think I've shown this one before, but I wanted to show it again. This is the New York Stock Exchange Composite. And one of the things that we noticed, and Carl noticed, is that if you look here at the NYA, and I'm going to give you, I want to have another, I want to have the S&P in here. So I'm going to add that to the top. Everybody can see how you can do that. Price. And also it goes to that. I'm going to put it above, and we'll see what that looks like. It'll give you, I just need you to see, give you a quick idea. So if you notice, when we hit the top back here in January on the New York Stock Exchange, that's when, of course, we hit the top in the S&P 500. Notice that back in October, the S&P 500 managed to make a new high, but the New York Stock Exchange did not. And so the idea is we always talk about a bear market being 20% or more move down. And if you take it, looking at it through the New York Stock Exchange's eyes, the bear market could very well be over. You have the top that was here, and it took us down here to test it. And, that's giving us that possible, here's the bottom, and now it's time to move up and continue. So I thought this was interesting to show you because it does give, bulls, of course, more ammunition. And it does make me go, maybe it's time to, I'm not necessarily looking at a test of this December low, but I still am looking for a corrective move at this point. But this chart certainly made me go, because, technically this could have been considered, a big time bear market for the New York Stock Exchange that we might already be coming out of right now. All right, another one I'm going to show you. The accumulation distribution line versus the OBV. And Tom, you had asked Carl about a comparison of the two. And so he went ahead and looked at it. And I'm actually going to stretch this chart out just a little bit, make it a little wider for us here. Oh, not that wide. There we go. All right. So what he did is he looked at the various divergences and confirmations. And what we found when the research was done is that the OBV actually gives you the divergences more so than the accumulation distribution. You tend to get confirmations out of the accumulation distribution line. And while that is helpful, divergences are usually a lot more interesting, and they usually are giving you more information. So in this case, if you watch the OBV, so you had a confirmation of this up, right, the up move here, yet the OBV was starting to trend lower, and that was key information with that negative divergence that we could see a drop, and we certainly did. This was the end of this really bad corrective move and time here earlier in 2018, and you got a positive divergence right there on those two lows on the OBV, and that gave you information that we might be ready to move to the upside. Well, what happened with the accumulation distribution? It was a confirmation. It was confirming that we had a lower low on the price, and that it actually would suggest that maybe we would be continuing lower. Well, that's not what happened. Look over here. We have a confirmation of this move to the upside on the accumulation distribution. But on the OBV, we have a negative divergence. And again, that tells you information that you really, confirmations are great. I'm not saying they're bad, but the divergences are what really, that's going to give you the important information. And you can see right here, we had the negative divergence right before that decline on the OBV, but not the same thing on accumulation distribution. OBV, let's look again. We had a negative divergence here on these tops, right? And we also got the negative divergence on accumulation distribution. So they were both in line with each other with a negative divergence, giving us a warning that we should expect something to the downside. And then as well, both the OBV and accumulation distribution came in with positive divergences at that low back at the end of December. On this in particular is the Apple chart. So I may have confused things there, but this gives you an idea of, honestly, the OBV is simplistic, but you know, I've been following it since I was a teenager. I'm not exaggerating. I used to look it up with a ruler in the Barron's and look up all of the Dow stocks and write down the volume and use a calculator, which was very expensive at the time, I must say, and use the calculator to calculate the OBV every market day for my dad. So I understand it. It's very simple. If you have an up day, you add the volume to the on balance volume line. If you have a down day, you finish down, you subtract all of the volume. And I understand that sometimes you're going to get it a little bit skewed because of that. But overall, I think the simplicity helps you in your mind to figure it out. Accumulation, distribution, money flow, they use similar information, but they determine they split it up. They split the volume up based on, you know, the close and the open. And so you can kind of you end up with a lot of emphasis on parts of the volume and not on the other part of the volume. And so I think with OBV, the fact that it takes all into account, that can be really interesting. But if you want to know more about those, because I think it might be useful to see, I just explained oh, there it was. I just explained the OBV. So I want to show you this because I know I'm probably, the formula that I said probably isn't the best here. Let's go ahead and look. All right. So this is how you come up with the volume on the accumulation distribution line. Like I said, you're really you're giving the volume to the winner of the day, and you apply it differently for both. And so if you want to have more information on how the accumulation distribution line works, here you go in Chart School, and you can look at the OBV. But as I said, I felt that it was pretty good. So here is the accumulation distribution line and the OBV, and you can see the difference in how they would be calculated here. So this is where you get those differences. And like I said, based on what I was seeing on that Apple chart, that could be a good thing because it does give you some divergences rather than confirmations. So that was one of the other charts that made me go, all right. This is one we need to be paying attention to very closely. And Carl and I both admitted when we showed this chart on the Decision Point show that we didn't catch this negative divergence that was basic. It was there. It was glaring, and we didn't see it until it was too late. So what I'm doing at this point is I'm starting to watch. You're seeing how the S&P, the PMO, is starting to curl over in overbought territory, because typically the range is -2 to 2. So it is starting to curl over, which is another reason why I feel like the market is looking toppy. What I'm going to be watching is to see where the OBV ends up after the next couple of days, because I want to see more tops. Right now, the tops are all confirming that move to the upside. So I want to see whether the next top is going to confirm or whether we're going to get that divergence. So that's something to keep a close eye on, I would say. All right. One of the ones that we talk about as well was, everybody asked me the difference between the PMO, PPO, why I use that. Well, Carl and I developed it, more so Carl and the idea. I was the math girl in the background. So we worked on getting the PMO together, the price momentum oscillator. And then a lot of people ask me, okay, what's the comparison and how do these work in concert or differently? And as well as we decided to add the No Sure Thing of Martin Pring in there as well. So here's kind of what I was looking at and what he was looking at. And obviously they look very similar. And part of the reason they are different, of course, is that our settings for the PMO are a little bit longer term than your PPO and MACD settings. So that does make a difference. For example, you can see that this buy signal came in slightly earlier than the PMO buy signal did. But one of the things that we noticed is that you get a lot of twitching on the PPO and the MACD, and which sometimes will cause you problems because you'll get these signals when it crosses below the signal line, and then you end up with a whipsaw, and then you could end up right back down. But meanwhile, the PMO has, generally stays in its where it's supposed to be during a rising trend like that. So here it was a little bit bumpy. It was sort of hard to figure out what was going on. But the PMO is nice and smooth. Part of the reason, though, like I said, is certainly the settings here. But these are the default settings. We use the PMO, what I use the PMO for all the time. So looking at the PPO versus the PMO, interestingly in the thumbnail, I noticed that the PPO has rising tops here, declining on the PPO. So that's rather interesting. And that goes to rising tops here and declining tops over here. So in this case, that is the negative divergence. The PPO actually picked that out before the PMO. So there's a positive. Also, so here's the KST, and it's even smoother, obviously, than the others. But the main thing I just wanted to point out is that, the twitchiness and the false signals that you actually can get with the shorter PPO and the MACD. So, and then of course the KST is very smooth. It's which is great, but those signals tend to come in kind of late as well. Alrighty, so that was one that makes you go, And then the final one I think I'm going to talk about here, I have to show you one other thing after this. One of the things that Carl, and what you can find on stock charts is you actually can chart the unemployment rate. And so he did a line chart, a weekly one, just to see, what was happening with the unemployment rate versus what was going on in the market. And I just want to see if I can't. Yeah, that's the most recent that we can get. All right. So, obviously they are negatively correlated. Reminds me of the dollar and gold. But it makes sense, right? As unemployment, when it hits its lowest rate, you're usually coming in at the end of a really prosperous time in the market. So you tend to get these, the unemployment rate when it starts to rise, that tends to be your information that we might start seeing a decline as far as the market goes. And so Carl took this out, and then we looked at it just to see at these peaks and valleys, what happened with the market. And so we notice right now that the unemployment rate has risen slightly here. The market has really took a downturn on that information after, we were lower here, and then that came in. You can see it really, obviously the market had other reasons why it took a dive, but interestingly, it did match up fairly well with the fact that the unemployment rate has started to rise slightly. That was as of January 2nd. And then I'm going to show you one more thing, and that is the candle glance for all of the sectors. And I kind of did this yesterday at the end of the show. I'm going to do a repeat. You get more information every time. And today with everything starting to decline somewhat, I'm now getting sell signals on some of these charts as far as the sectors go. You can see communications XLC has now, looks like it's going to log a sell signal today. Who else is going to log a sell? Real estate, actually. And interestingly, being a defensive sector, it is logging a sell signal today for the PMO more than likely. Currently, financials, it looks like we've got an even reading. But all of these, you could see sort of turning themselves over on the PMO or decelerating. And though we haven't gotten sell signals on all, looks like discretionary might be getting close to one sell signal there. And as far as which ones look the healthiest, I think that when I look at technology and utilities, I like the looks of those still. So you could see the PMO is now turned up on the utility sector. We got the breakout from the high back in December, so that looks pretty good. And then if you look at XLK and get a closer look, while we are seeing that deceleration on the PMO, I think that we've got a bit more margin between the signal line and the PMO than we do on the others. So that was the other thing that made me go, we might be looking at a top coming here. And of course, it's arriving right about that time. Go over here. It's arriving, all of these are arriving right when we're starting to turn back over on the PMO for the S&P. I see this bearish wedge. I think it's time for a correction and a minimum of pullback. So that's what I got, Tom. I don't know. Did any of those make you go,
Yeah, I mean, I kind of found the unemployment rate interesting because I like to use the jobs. I use non-farm payroll employment to see, because in the past we've seen slowdowns in jobs before we've seen the S&P 500 move down. And what I'm seeing right now, using the rate of change of 12 months, is that jobs are accelerating to the upside. I really thought back in January and February that we might have a bad jobs report that would hurt the market, and it never happened. So I don't know. I think that certainly all of that's worth watching. But obviously the market's got to break down first before we have anything like that to worry about. Any
right. So anyway, if you go Fridays for our show, you might get something that'll make you go at the end.
No doubt. And there's so many different ways to look at the market: short term, longer term, using fundamental data, using technical data. I mean, seasonal. We went over and did, showed a lot of seasonal information today. A lot of different ways to look at the market. All right. I want to thank everybody for being with us today. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everyone. We'll see you back here tomorrow. Happy trading.